Have you ever wondered what the people who actually move the markets are really thinking? I'm not talking about the talking heads on TV, but the institutional investors, the real smart money. Well, today, we get to be a fly on the wall. We're pulling back the curtain on an exclusive Goldman Sachs survey that gives us a super rare look at how their top clients see 2026. All right, let's jump right in. So, here's the big question on everyone's mind. Now, just to be super clear, this isn't some random online poll. The data we're about to dig into comes from a survey done in early December 2025, and it's exclusively for validated institutional clients on Goldman's professional platform, Marquee. These are the heavy hitters. Yeah, you can basically think of this as Wall Street's secret survey. The insights here are fresh, they're timely, and they come from the very people whose decisions can literally shape the entire market. And this quote just nails it. This isn't about feelings or general sentiment. It's about strategy from the most professional voices in the entire game. I mean, these are the folks managing massive, massive funds, so their collective wisdom, that's a seriously powerful indicator. So what's the overall vibe? What are they feeling for the year ahead? Well, the first major takeaway points to a feeling of cautious optimism. Let's see what the numbers have to say about the S&P 500. Okay, so check this out. At first glance, you see the breakdown, right? 47% are slightly optimistic, another 14% are very optimistic. But the real story is when you add them up. That's over 60% of these top investors who believe the market is heading up in 2026. So what's driving all that optimism? It all comes down to this number right here. An absolutely huge 85% of them expect solid US GDP growth, somewhere in that sweet spot between 1.5% and 3.5%. That is an incredibly strong vote of confidence in the economy. And if you want to see just how confident they are, get a load of this. A tiny, minuscule 1% of these VVIPs see a recession as a real possibility. I mean, for all practical purposes, the people with the most skin in the game have taken recession right off the table for 2026. But, and this is a really important but, here's the nuance. While they believe in growth, that wild, aggressive bullishness we saw before, it's cooled off. Earlier surveys had much higher targets. Now the consensus is in a more realistic zone. It's why we're calling it cautious optimism. They're pretty sure which way the wind is blowing. They're just not expecting a hurricane. All right, now let's shift gears to the hottest topic on the planet, AI. Because the way these pros are approaching artificial intelligence is going through a massive, massive shift. The free-for-all is over. You know, that initial almost blind love affair with AI, it seems to be fading. A full third, 1 out of every 3 of these investors, are now pointing to some very real problems, like insane costs and growth that just hasn't lived up to the sky-high hype. The euphoria is definitely making way for a much more critical eye. And this slide just lays it all out, doesn't it? In the past, it was all about investing in the idea, the hype, the potential. Now, it's all about the fundamentals. They're digging into profitability, execution risk, and exactly how much cash a company is burning through. The days of just slapping AI on your company name and watching the stock go to the moon? Yeah, those are over. You know, there's actually a perfect Korean term for this new phase, oksuk garagi. It literally means sorting gems from stones. And that's exactly what's happening in the market. Investors aren't just buying up the whole AI sector anymore. Nope. They are carefully sifting through, looking for the true gems, the companies with proven performance, and a clear path to actually making money. So, if they're feeling pretty good about the economy and getting really selective with AI, what's the catch? What are they worried about? What's the one thing that could throw a wrench in this whole cautiously optimistic story?
And here we have it. The number one thing keeping these investors up at night is the labor market. Almost 3/4 of them expect the unemployment rate to start ticking up. And even though a moderate rise doesn't sound too scary, it introduces a huge amount of tension into the outlook.
Okay, but why is a little uptick in unemployment such a big deal? Well, it all comes down to something called the SAM rule. And this rule is a historically reliable, almost uncanny indicator. When the 3-month average unemployment rate climbs just 0.5 percentage point above its recent low, it has almost perfectly signaled the start of every recession. Which brings us to this really fascinating paradox at the very heart of this survey. See, on one hand, these investors believe a recession is basically not a threat. Only a 1% chance, remember? But on the other hand, their single biggest worry, rising unemployment, is the primary trigger for the very thing they think won't happen. It's a real economic tightrope. So, with this complex picture of optimism clashing with some serious risk, where are these investors actually looking to put their money? Well, it looks like their search is expanding beyond the usual suspects. So, where's the smart money flowing? A few key places. First, they're definitely looking more globally, at developed markets outside of the US and also into emerging markets. This tells us they don't think growth in 2026 is just going to be a US only story. And second, back at home, they're looking very closely at US Treasuries, which is basically a bet that interest rates or yields are probably headed down. But they're being a lot more careful in other corners of the bond market, specifically with corporate bonds. They expect something called credit spreads to get wider. Now, the easiest way to think of a credit spread is it's the extra reward you get for taking on the extra risk of lending to a company instead of the super safe US government. If that spread gets wider, it means investors are demanding a bigger reward because they see more risk ahead. And that's exactly what these pros are expecting. Whew. Okay, we have covered a ton of ground here. Let's take a second and boil this exclusive peek into Wall Street's brain down to the most important takeaways. So, if you're going to remember three things from this whole breakdown, make it these. First, the overall mood is cautious optimism. They believe in growth, just with more realistic expectations. Second, in the world of AI, the era of gem sorting is here. Performance is now king, not hype. And third, the biggest wildcard, the ultimate test for this whole outlook, is the labor market. All eyes are on those employment numbers. And that really brings us to the final question, the one for you to think about. The pros on Wall Street are carefully walking this tightrope between optimism and realism. So the question is, how does their professional view line up with your own strategy for 2026? And maybe even more importantly, now that you've seen their logic, where might you need to think differently?